A very good morning to all the participants of this webinar, and we are starting a discussion on inventories within our topic of bookkeeping and accountancy. And in this discussion and the subsequent webinars on inventories, we'll be studying what is the meaning of the term inventory and what are the techniques of inventory valuation. And of course, we'll understand the methods of the inventory record keeping, and we'll also understand the complexities relating to how we take the inventory and how we keep a record of the inventory. Broadly speaking, the inventory is kept by two types of concerns: the trading concerns and the manufacturing concerns. The trading concerns keep the inventory of the traded goods. The manufacturing concerns keep the inventory of the five types of things like raw material, work in progress, finished goods. Work in progress means those items on which processing is going on, it's not complete, goods and spares, and the packing material, because all these things are in substantial quantity in manufacturing concerns. As far as the inventory valuation techniques are concerned, they are broadly categorized into historical methods and non-historical methods. Among the non-historical methods, we have the adjusted selling price method, and among historical methods, we have two types of inventories, and for them the methods are different. One is the type of inventory which is not ordinarily interchangeable with each other, which is not uniform, and the other type of inventory which is ordinarily interchangeable with each other, that is, which is uniform type of inventory. For the inventory which is not interchangeable, where every item is a specific item, there will be a specific identification method valuation that will be used. And for those inventories which are uniform in nature, we have a historical cost method of FIFO, LIFO, and weighted average price. We'll understand this as we go forward. The very basis of inventory valuation is cost or net realizable value, whichever is less. So the basic premise before us when we are doing inventory valuation is that we have to get to the cost, we have to get to the net realizable value, and then we have to take the lesser of the two. Now let us understand what inventory is all about. You see, inventory can be defined as those assets which are either held for sale in the business, just like the trading concern, or those assets which are in the process of production for sale, and those assets which are held for consumption in the production of goods or services for sale. So certain assets which are consumed in the production of goods or services for sale, they are also the inventory. They are held for consumption. Then those assets are held in the process of production for sale. They are those items which are inventory, and the items which are actually held for sale. And of course, we have to keep in mind that maintenance, supplies, and consumables are also included in inventory. However, the machinery spares and the servicing equipment and standby equipment are not to be included in the inventory. Machinery spares means any spare parts that are required to repair the machinery, any servicing equipment that is required to service any machinery, or any standby equipment which is kept to standby for maintenance or for any other reason as a replacement for the machinery. Now, having understood the broad categorization we'll just go to the three types of concerns where inventory is. So first of all, we have the trading concern. And in the case of the trading concern, primarily the products which are purchased for resale are there in existing form, and they form the inventory of a trading concern. However, this trading concern may also have inventory of the supplies such as the wrapping paper, carton, stationery, what we mean to say the packing material and the stationery. Because a trading concern may have a large amount of wrapping paper, cartons and stationery also, because nowadays for selling traded items we need a lot of packing material. Then we move to the manufacturing concern, and the inventories of manufacturing concern will consist of primarily of the raw material, and this raw material will become part of the goods to be produced. And then of course we have apart from raw material, we have the work in process. So when we say raw material which will become part of the goods to be produced, we are referring to this second part here, assets held in the process of production for such sale. So here we are referring to the raw material, and then we have the work in process, and work in process means those items which are being consumed in the production of goods or services for sale. They are being consumed, the work is not yet completed, the work is in process on the items. So those items which are in work in process, those which are the raw material, and those which are the finished products, these are broadly included in the items of inventory for manufacturing concerns. However, in the manufacturing concerns, you will also include maintenance supplies, consumables, the loose tools, and the spare parts. So these are broad things which are to be included, but however, we must understand that out of these, what has to be specifically excluded, we must understand, because we have to understand that inventories do not include those spare parts, servicing equipment, or the standby equipment which can be used only in connection with one item of the fixed asset, and not with other items of the fixed assets which are connected with only one item of the fixed assets and whose use is expected to be not very regular. So those items which are not regularly used as spare parts, servicing equipment, or standby equipment, and which are connected with only one particular asset, they are not included in the inventories. However, otherwise, if there are spare parts which are used in all the which are regularly used and used for various assets, then those spare parts can definitely be included in the inventory. So there is a minor fine distinction here of the spare parts which can be included and the spare parts which cannot be included. Of course, the servicing equipment and the standby equipment, as far as these two things are concerned, generally they are kept out of the inventory definition, because this equipment is used to do the servicing of the asset, and if they are used to do a servicing of only one particular asset and they are not regular, then they are certainly not to be included. But you can take it that if there is some servicing equipment or standby equipment which is regularly used and which is regularly used for various assets, then even then it becomes part of the fixed assets, because something which is already part of the fixed asset cannot be treated as inventory. Inventory is that thing, which inventory is that thing which is generally used in the process of the business, or which is sold in the process of the business, or which gets used in the process of production, or which is consumed in the process of production, and finally leads to some sale. Any such servicing equipment or standby equipment which is servicing one particular asset or which is servicing an asset is generally accounted for as part of that fixed asset itself. So there is a distinction here that something which can be treated as part of a particular fixed asset, then that thing will not be treated as an inventory, and something which cannot be treated as a fixed asset will only be treated as an inventory in this case, as far as the spare part servicing equipment and standby equipment are concerned. So the test case over here is that we have to see whether it is being regularly used. Number two, we have to see whether it is being used only for one fixed asset. And we have to also identify whether it should be treated more as a fixed asset or more of as a inventory. So if there is if there are some loose tools, let us say, and there are some spare parts, let us say, without which production is not possible, without which manufacturing is not possible, and those loose tools are continuously consumed while production is going on because the machinery has to be kept in operation on a day-to-day basis. So some loose tools will be required to keep the machinery in operation on a day-to-day basis. Those kinds of spare parts or loose tools can be included under the head of inventory because they are getting consumed into the machinery in the process of production or in the process of consumption for production. So therefore, all such things which can be treated as if they are regularly utilized on a day-to-day basis for doing the production, for doing the manufacturing activity, and those things can be treated as part of the inventory. But if there are some spare part servicing equipment and standby equipment which are not used regularly or on a daily basis, and they are related to one particular asset and can be treated as part of one fixed asset, then they are treated as part of that fixed asset and not treated as an inventory. We'll come to the examples and then we'll understand this thing even better. Now, when the year ends, what happens is that every business entity wants to ascertain that what is the closing balance of the inventory, which is raw material, work in progress, finished goods, and other consumable items. So, to understand or to know what is the closing balance of the inventory, the value of the closing inventory has to be put on the, after knowing it has to be put on the credit side of the trading account, and it has to be put on the asset side of the balance sheet also. So the balance sheet cannot be prepared, the trading account cannot be prepared till the time we have this inventory with us, the value of the inventory. Even before preparing the final accounts, the accountant should know the value of the inventory of the business entity. So let us go ahead and see how inventory valuation is to be done for a manufacturing concern and for the goods of a trading concern. So coming to inventory valuation, the primary issue in valuing the inventory or accounting for inventory is that we have to determine the value at which the inventories are carried in the financial statements until the related revenues are recognized. Because here what is happening is, the primary issue here is that we have to decide how much will be the value of the inventory, because the revenue is not recognized so far. Till the time the related revenue is recognized, which means that till the time the inventory is sold off, we have to keep it in our books at a certain value. So therefore, till the time the related revenue gets recognized, we mean to say that till the time the inventory is sold and we know how much revenue we have got from it, we have to ascribe certain value to the inventory, because we have to keep that inventory value as part of the balance sheet as well as the part of the trading account. Without doing that, we won't be able to get the real or true or fair picture of our profits. So the inventory is generally the most significant component of the current assets part in our financial statements. So it is widely recognized that inventory is one of the major assets that affect the efficiency of the operations. If you have excess inventory or if you have short inventory, it will affect the production activity and the profitability of the enterprise also will be affected if we have excess inventory or short inventory. Inventory should be just right. Proper valuation of inventory therefore has a very significant bearing on financial statements authenticity. So significance of inventory valuation arises due to various reasons. Now we have to understand the significance of inventory valuation. What is the significance of inventory valuation? If we value inventory correctly, how we are benefited by it, we have to understand. We have, for getting the significance of inventory valuation, we will consider some points now. The first point is that determination of income. So, in order to know the income, we have to know the inventory during a particular period. And if you have to talk about income, let us first talk about gross profit. So, to find out the gross profit, we have to match the cost of goods sold with the revenue of the accounting period. Now, if you have to calculate the cost of goods sold, we have to start with opening inventory, then add the purchases to it, then add the direct expenses of the purchase, and then reduce the closing inventory. So here you are having the closing inventory. Unless you reduce it here, you won't be able to find out the cost of goods sold. And if you are not able to find the cost of goods sold, you won't be able to find the gross profit. And if you are not able to find the gross profit, then you will not be able to find the income. So to determine the income, it's very important to find the closing inventory. Now, therefore, inventory valuation, whatever value that you ascribe to inventory, will have a major impact on how much income is being determined. If the merchandise cost is large fraction of the sales price. So, whatever amount is being sold, if not much work is being done on the products being purchased and directly the products are being sold, just like in a trading concern. If the merchandise cost becomes a large fraction of the sales price, then the effect would be even more of the inventory valuation. So let us understand what is the effect if we overstate the inventory or if we understate the inventory. Number one, when the closing inventory is overstated, the net income will get overstated. Opening inventory is overstated, then the net income will be understated. We are going by this formula here. When closing inventory is understated, then the net income will be understated. And when opening inventory is understated, the net income will be overstated. So the effect of misstatement, understatement or overstatement of inventory figure on the net income is coming through the cost of goods sold here. Therefore, proper calculation has to be done of the cost of goods sold, and for that matter, proper valuation of inventory will be necessary because we need the proper inventory valuation for finding out the cost of goods sold. And therefore, for proper determination of correct income, we need to have the closing inventory valuation correctly done. Now, to understand the significance further of how important this inventory valuation is, let us go to this point, and we say that inventories are actually current assets. So, whatever value of inventory is there on the date of the balance sheet, it will be required to determine the financial position of the business. So second point is that to determine the financial position that is coming from the balance sheet, we need to determine the closing inventory, because the closing inventory will affect the value of the current assets, and the value of the current assets will determine the value of the financial position, or rather it will affect the financial position of the ascertainment of the financial position of that concern. So that is how inventory is important to find out the financial position. Then inventory is also important to do a liquidity analysis. Liquidity position of the business means how much ready cash business has, or how much easily convertible cash business is having, because sometimes when it needs the immediate cash, then it needs to understand what are those current assets, because current assets can be easily liquefiable. So inventory being also classified as a current asset, it is one of those components of the net working capital. Net working capital means that is a capital which is working day-to-day basis, which is available for use for the business, and therefore as current assets, being part of the current assets, as inventory is a very important component of the net working capital, and net working capital reveals the liquidity position of the business. Therefore inventory is important to get a liquidity analysis. Current ratio, which is the current assets upon current liabilities, the relationship between current assets and current liabilities, will be very significantly affected by the inventory valuation amount. So we go further and we understand what is the significance. Why do we do the inventory valuation? Another important reason is that it is prescribed by the law to do the inventory valuation. The Schedule 3 of the Companies Act 2013 has made it mandatory that valuation should be done of each class of goods. That is, we must do separate valuation of the raw material, a separate valuation of the work in progress, a separate valuation of the finished goods. So these broad heads have been Schedule 3, work in progress and the finished goods, for which valuation has to be done, and this has to be disclosed in the financial statements. Moreover, the accounting standards have also required that the financial statements should disclose the accounting policies which are adopted in measuring the inventory, and is made mandatory by accounting standard to include the cost formula that is being used to find out the cost of the goods sold. And the accounting standards have also made it mandatory to disclose the total carrying amount of inventories and its classification, the inventory classification, which is appropriate to that particular enterprise. So when we say classification, the same thing: raw material, work in progress, finished goods. And if there is some additional classification done, then that should also be disclosed as per the accounting standards. So both the accounting standards and the Companies Act are making it mandatory to do the inventory valuation, and they are even prescribing certain heads under which the inventory valuation needs to be disclosed. So the common classification of the inventories in work in progress, finished goods, stores in trade, in respect of the goods acquired for trading, and the spares and loose tools. So spares and loose tools are also common classification for inventories. We must keep this in mind. This comes under consumables. So broadly speaking, we say raw material, work in progress, finished goods, and consumables, and of course the traded items, which are classified as inventories. So having understood the significance of inventory valuation, now we go towards the basis of the inventory valuation. What is the base of inventory valuation? What we mean to say is that how do we really understand the meaning of what is inventory valuation? So that once we know the basis of inventory valuation, we can go ahead and check out the techniques of inventory valuation. So inventory should be valued. The basic foundation is that inventory should be valued at the lower of the cost or the net realizable value. So we have to find out the cost, then we have to find out the net realizable value, and we have to check whether the cost is less or the net realizable value is less, and whichever one is lesser, that will be the valuation. Now this is a principle which is governed by conservative accounting principle, and the conservative accounting principle says that any expenses or losses from transactions which are entered into or events which have occurred have to be immediately recognized. So the expenses or losses have to be immediately recognized. However, gains or profits are recognized until it becomes due, or are not recognized until it becomes due or actually realized. So gains or profits will not be realized. You must read it, this sentence like, however, any gains or profits are not recognized until it becomes due or are actually realized. So gains and profits will be realized only or recognized only in the books of accounts when they are actually realized or they become due. So only on real accrual or on actual realization, the gains or profits will be recognized. We will not jump to recognize the gains or profits. That is the conservative approach or conservative principle. It is also, we can say, part of the prudence principle also. So under the principle, when we say the principle of lower of cost or net realizable value, this principle is based on the principle of conservative accounting. So under this principle, lower of cost or net realizable value, any loss which is due to the decrease in the sale price of the inventory below its cost. If the price of the sale price of the inventory goes below its cost, that decrease is recognized immediately, as it is anticipated by the enterprise that that thing will be sold at lesser than the cost. So some losses may accrue, and therefore whenever they will sell, they are understanding that, well, the cost has gone down, the sale price has gone down in the market below the cost, so we must recognize it. Otherwise, we may not get a true picture of our accounts. So as far as costs are concerned, because the basic principle is cost or net realizable value. Now, to understand what cost is, as per accounting standards, the cost of the inventories will comprise of, number one, purchase cost. Number two, the cost of conversion. This is for finished goods and work in progress, because for whatever cost of conversion from the raw material to the finished goods or from raw material to the work in progress is there, that is called cost of conversion. And there will be other costs also which are incurred in bringing the inventory to the present location and condition. So these are the three elements of costs: the cost of purchase of the items, the cost of conversion in the factory if it is a manufacturing concern, and the cost of bringing the inventory to the present location and the condition. So cost of purchase, we all know very well, but let us understand the components of cost of purchase also. So in the cost of purchase, duties and taxes will also be included, other than those liquid duties and taxes which are recoverable from the taxing authorities or which are given back to the business due to some duty drawback scheme or something. Then freight inwards would also be part of the cost of purchase. Whatever freight is paid as part of the purchase cost, and apart from that, whatever other direct expenditures are there which can be related to the acquisition of the item which is purchased, or which can be attributable to the acquisition of the purchased item, those expenditures will also be included in cost of purchase. So therefore, trade discounts, rebates and duty drawbacks and other similar items will be deducted, will be reduced in determining the cost of purchase, because the trade discount is given to that person, so that for him the cost is not before the trade discount but after the trade discount. Similarly, duty drawbacks, rebates, etc. are also reduced to find out the cost of purchase. So just to understand this, cost, in other words, will include any amount which is paid to the seller, reduced by whatever discount rebates given by the seller, and of course including the duties and taxes. So similarly, any duties which are paid to the supplier will be part of the cost of the inventory, if the enterprise cannot recover those taxes from the authorities. Now, what is cost of conversion? Cost of conversion is those costs which are directly related to the units of production which are being produced in the manufacturing factory, just as we can say direct labor, because in converting the raw material into the finished goods or in work in progress, labor is utilized. So labor is one of the components. There could be many other costs of conversion also. So all the fixed and variable overhead expenditures that are being undertaken, we are allocating those expenditures in a systematic way in order to calculate the cost of conversion. A detailed analysis of how the cost of conversion are calculated in the factory will come later on. The third other can include the administrative overheads which are incurred to bring the inventory. Only those overheads which are incurred to bring the inventory to present location and condition, or any cost which is specifically incurred on the inventory of a specified customer, where some customer needs a cost to be incurred for a particular inventory. And then interest and other borrowing costs are generally not included in the cost of inventory. We are taking loan to buy certain items. No, that interest will not be included in the cost of the inventory. However, in some circumstances where the production process is very long and is required to carry the inventory with us for a long period of time, that is like a wine business or a rice business or a timber business, in such cases where production process is longer, it may become appropriate to consider the interest also and other borrowing cost also as part of the cost of inventory. So you have to remember this, that interest cost will not ordinarily be included, but for the processes which are longer in nature, it may be appropriate to consider the interest as part of the borrowing cost, because there the interest is affecting the cost of the valuation of the inventory, because constantly to get to the working capital, the items are not being sold so fast. The items, when the items will be sold, then the liquidity will be available, but the production process is so long that before sale you have to make a lot of investment. So inventory, so loan becomes a very necessary part of such a business. So unless you have the liquidity, you cannot invest. So if you don't have the liquidity, you will not be able to produce the wine, rice and timber, etc. And therefore, to get to the liquidity, you have to take the loans, because straight away you are not able to sell the product. When you will sell the product, then you get liquidity. But till the time you are selling the product, you are having to make the investment. So therefore, in such businesses where wine, rice, and timber businesses are concerned, or other long-term businesses, long-term production processes, interest would also become part of the inventory valuation in those cases. Now we have to understand that having understood that what are the costs, the three types of costs which have to be taken into consideration while doing the inventory valuation, because cost is one element and the net realizable value is the other element of the inventory valuation, the basis of the inventory valuation. Now we have to understand what are those exclusions which are needed from the cost of the inventories. We must understand what we don't have to exclude, what we don't have to include at all as part of the inventory valuation. So, number one, abnormal amounts of wasted material. If a reasonable wasted material is there, that is fine. But if abnormal amount of wasted material, abnormal amount of labor, or abnormal amount of the production overhead is being used, that abnormal amount will not be included in the cost of inventories, because that is not a norm. That it is possible abnormal expenditure has happened on the labor or on production overheads, or abnormally some certain items have been wasted. But this abnormality will not get included while valuing the inventory. Then, of course, the storage costs are also excluded unless those costs are part of the production process. For example, if the production process is going on and certain item has to be kept in some place for some time before it is used up or consumed in the subsequent production process. So unless those costs are necessary in the production process, which is prior to the further production stage, otherwise the storage costs will not be included in the cost of the inventory, because once the inventory is made, it is prepared, it is just kept somewhere. Now, if the inventory is kept somewhere, the storage cost will not be included in the cost of the inventory. If the inventory is being kept before it is sent to the subsequent production process, then that storage cost would be included. So third is administrative overheads that do not contribute to bringing the inventories to their present location condition. So only those administrative overheads have to be included which are contributing to bringing the inventory to present location or present condition. And finally, the selling costs or the distribution costs will certainly not be included as part of the cost of the inventory. So having considered the cost part of the inventory valuation basis, now we go to the net realizable value part, and let us understand the net realizable value. Now, net realizable value is our estimate of what could be the selling price in the ordinary course of the business, and from there we minus the estimated cost of the completion and the estimated cost necessary to make the sale. So what is being done here is to get to the net realizable value. If the item is so far not completed, then first we take the estimated selling price of the item in the market. From there we reduce the cost of the completion of that item, whatever costs are left to be incurred to complete that item. And we also reduce the estimated cost necessary to make the sale. So selling and distribution expenses have to be reduced. The cost of completion of the item has to be reduced also from the estimated selling price of the item. So in case it is finished goods and traded goods, net realizable value will generally mean the selling price. The selling price would be reduced by the selling and distribution expenses. And in case of work in progress, all the expenses and overheads which are required to be incurred to convert the work in progress into the finished goods. whatever expenses are required to be incurred, whatever overheads are required to be incurred, to convert the work in progress into the finished goods and to make it ready for sale, to take it to the present location condition for sale, to be able to be sold. All these expenditures will be reduced from the selling price available in the market for that item, and then only we'll be able to calculate the work in progress. Thirdly, in case of the raw materials, what is to be considered as the net realizable value is the replacement cost of the raw material. Replacement cost means that if I have to sell the existing raw material and I have to buy a new raw material instead of that. So what will be the replacement cost? When we say replacement cost, we don't mean to say just the selling price. Selling price of the raw material minus the salvage value if I sell the present raw material with. So raw materials have to be valued at the replacement cost. The work in progress has to be valued by taking the estimated selling price and reducing the expenses and overheads required to convert it into the finished goods and making it ready for sale. And as far as finished goods are concerned, they are valued at the at the selling price, estimated mean selling price or estimated selling price reduced by the selling and distribution expenses. So therefore, having understood net realizable value, we have to make an assessment for the balance sheet date of the inventory. So the inventory are usually written down to the net realizable value on an item by item basis for the balance sheet date. Because the valuation may be done, the quantity or the measurement may be done even after the balance sheet date. The assessment of the valuation or the inventory valuation has to be done for the balance sheet date for which the balance sheet is to be made. We should not do the valuation for a further subsequent date or a date before the balance sheet date. Therefore, we have to estimate the valuation for the balance sheet date. So what we do is that inventories are normally or usually written down to the net realizable value on item by item basis. Written down to the net realizable value means written down to the net realizable value for the balance sheet date on an item by item basis. Written down means it is if we are taking the net realizable value, we are taking the inventory valuation later on also, we have to write that down to the balance sheet date. We have to write it down in such a manner that we use the valuation, we use the rate of valuation for the balance sheet date, the prices which are available on the balance sheet date. And in some circumstances, however, it may be appropriate to group the similar or related items. For example, in case of interchangeable items, if items are interchangeable in nature, we can group them together because it may not be possible to identify every item interchangeable. They look like each other. They are uniform in nature. So in that case, we'll just group them together and take the value. Because it is not possible to separately identify each item. We have no way to find out which item is which item by looking at it. For example, if there are red colored balls of identical nature, how do we know as to which ball was bought with on which date and under which bill? Because we are not able to, there is no identification mark on the ball. Therefore, in case of interchangeable items, we can group them together and then take the value. Now, let us move into what systems do we adopt to record the inventory. Now coming to recording of the inventory, because having understood the basis, the net realizable value or cost, what are the components of the basis of the inventory valuation, we have to now understand what are the recording systems that are available with us for valuing the inventory, or for recording the inventory rather. So broadly speaking, there are two principal systems for determining the physical quantities and to determine the monetary value. Monetary value means the money value of the inventories which are sold and the inventories which are in hand. Now these systems are, one system is known as the periodic inventory system and the other system is known as the perpetual inventory system. Out of these two systems, which help us to determine the physical quantities, which means that we are recording this, these are the recording systems which help us to determine physical quantities and the monetary value also. The periodic system is less expensive to use and perpetual method is more expensive to use. But useful information which is obtained from perpetual system is more than the cost incurred on it. So even if we are incurring more cost on having a perpetual system, but it is giving us much more useful information. So we can say it is a cost-effective system, much more cost-effective than periodic inventory system and much more useful. So these systems are distinguished on the basis of the actual records which are kept to ascertain the cost of goods sold. So basically, the main purpose of keeping inventory is to find out the cost of goods sold, as we have seen. Because once we have the cost of goods sold, then we have the gross profit, and once we have the gross profit, we have the income. And of course, the closing inventory valuations. So closing inventory valuations help us to find out the cost of goods sold. The closing inventory valuation help us to find out the correct current assets, and the correct current assets help us to find out the exact financial position of the business. And therefore, the actual records which are kept to find out the cost of goods sold and to find out the closing inventory valuations, these actual records distinguish these two systems, periodic inventory system and the perpetual inventory system. So to say that these two record keeping systems are distinguished by their actual records that they are keeping to find out the cost of goods sold and to find out the closing inventory valuations. Now, let us look at what periodic inventory system is all about. So periodic inventory system is a method of finding out the inventory by taking the physical count or the physical measure or the physical weight of all the inventory items on hand on a particular date on which the inventory has to be valued. Now it is because of the actual physical count that the system is called the physical inventory system, because we are physically counting everything. So this periodic inventory system is also called the physical inventory system. So once we have been able to count on a particular date, then we can calculate the cost of goods sold by taking the opening inventory, adding to purchases, then reducing the closing inventory, which is physically counted by us. Now this system is simple and not very expensive as compared to the perpetual system. In this system, inventory account is adjusted at the end of the accounting period. At the end of the inventory account is adjusted to determine the cost of goods sold. When the cost of goods sold have to be determined, at that time inventory account is adjusted. Now this system suffers from number of limitations or weaknesses. So what are the limitations? Number one limitation is that physical inventory taking is required more than once a year for preparation of quarterly or half-yearly financial statements, and therefore this system becomes expensive because every now and then for every quarter or every half year and every year, the physical inventory of every item has to be taken. Now, when the physical count is to be taken, then at that time business has to be closed. So therefore, that is also a weakness of the system. We need to close down the normal operations of the business. Thirdly, as cost of goods sold is taken as the residual figure, it is not possible to identify the loss of goods due to pilferage, damage, or even fraud. So if some items are lost due to pilferage or due to damage or even due to fraud, it does not become possible to identify such loss of goods because cost of goods sold is taken as the residual figure. Residual figure means we take the whatever inventory that we are having with us, and then we take the opening stock, we add purchases, and then reduce the closing inventory which is available with us, and by that we get the cost of goods sold. So in this entire equation, this entire process, if some pilferage or damage or even fraud has happened, then we are not able to identify that. So inventory control is therefore not possible under this system if more inventory is being used up, if less inventory is being used up, like how much inventory is being used up to make how many production units. All that kind of inventory control is also not possible under the system, just as the pilferage, damage, or even fraud is not possible to be identified under the system. Now, the books of accounts do not reflect the inventory in hand and its value. Therefore, it is difficult to plan operations. For example, how much or when to order or when to manufacture more. It is not possible to plan that because the inventory in hand is not constantly reflected in the books of accounts. Because whenever we take the inventory physically, then only we are able to find out the actual inventory in hand. The inventory in hand is not always available to us, and therefore it does not help us in planning our operations as to how much we have to produce or how much we have to order or how much we have to manufacture. So therefore, as you can see, that this system should be used more by small enterprises where they don't need to make much investment in doing inventory work, and it is easy to control physical inventory because the items are all lying in front of them and they can easily look at them and also realize in their own way as to how much is required to be ordered or manufactured, or if they can have their own control over the pilferage, etc. also. So therefore, this system is used by small enterprises. The periodic system is used by the small enterprises. This system is not considered suitable by either the medium-sized enterprise or by the larger-sized enterprises also, because those medium and larger enterprises will use the perpetual inventory system. Now let us see what is this perpetual inventory system is all about. So the perpetual inventory system, it is a system of recording the inventory balance after each receipt and after each issue. You know, when we receive any inventory in our go down, or when we receive it in our record, and when we issue some, at that time itself, the inventory balance would be all the time we are having 100% of the time we are having the exact inventory balance or exact inventory valuation with us. In order to ensure the accuracy of perpetual inventory records, physical inventory should be checked and compared with the recorded balances. So how do we know that our perpetual inventory record is correct? For that, from time to time, we take physical inventory and check it against the perpetual inventory record. And when we compare the physical inventory record with the perpetual inventory record, as it is recorded in our books, we can understand to what extent our perpetual inventory record is correct. So under this system, the cost of the goods which are issued is directly determined, and the inventory of the goods is taken as the residual figure with the help of the inventory ledger, in which the flow of goods is recorded on a continuous basis. Now, this has to be understood very effectively. What is happening is that the inventory is the residual figure. In the physical system or in the periodic system, the cost of goods is the residual figure, and inventory is directly counted. Now, in this perpetual system, the cost of goods is directly determined because we are making entry whenever any item of inventory is received or issued. So the cost will get directly determined, and the inventory of the goods will be taken as the residual figure. And how the inventory will be taken as the residual figure? It will be taken from the inventory ledger, because in the inventory ledger, flow of goods is recorded on continuous basis. So when the inventory ledger is seen, in that the flow of goods is being recorded on a continuous basis, we can apply the techniques of valuation there to find out the valuation of the inventory. So this inventory valuation is coming to us as a residual figure after doing some computation based on the inventory ledger flow of goods, and inventory is not being directly generated from the physical counting. Therefore, inventory is the residual figure and cost of the goods issued is the direct determined figure. Why it is directly determined good figure? Because whatever goods we are issuing, we are making entry of the cost of those goods. So the basic feature of this system is the maintenance of inventory ledger. So here, inventory ledger maintenance is very important to have records of goods on continuous basis. So in the inventory ledger, every item of the inventory has a separate account. When that item was brought in, when that item was taken out. Closing inventory is then finally determined as a residual figure. How do we determine the closing inventory as the residual figure? Because we are getting cost of goods sold directly by this method, or cost of goods issued directly by this method. So we get the direct, we already have the opening inventory, we add the purchases to it, we reduce the cost of goods sold, and then we get the closing inventory as the balancing figure, as the calculated figure, as the residual figure, and not as a direct figure. So perpetual inventory system will help to overcome the whatever limitations are there in the periodic system, and because inventory is taken as the residual figure, it will also include the loss of goods, so we know how much goods are lost due to pilferage, etc. So the only main limiting factor in this system is that it incorporates more cost, or it requires more cost to be undertaken for using this system, because this is a perpetually always on type of a inventory system. And we can assume that as we are getting more and more computerized, perpetual inventory systems are coming into place and falling into place much more. And even small enterprise may like to have it if they need to have an accurate idea of their inventories. Now, both these systems are not mutually exclusive. You have to understand. They are complementary in nature. So when we say that they are not mutually exclusive and they are complementary in nature, what we are saying is that while doing even perpetual inventory system, we need to make some periodic inventory, we need to make some periodic physical inventory just to keep a check on the accuracy of the perpetual inventory system. In that sense, some amount of periodic inventory will be required for doing the perpetual inventory also. Now, to understand the distinction between both the systems, the periodic inventory system is based on physical counting, physical verification. Now, on the other hand, the perpetual inventory system is based on the recording which is being kept in the books of the goods issued, the value of the goods issued, the value of the inventory which is issued or received. Periodic inventory system provides information about the inventory and the cost of goods sold at a particular date. But the perpetual inventory system provides continuous information, not just for a particular date, for all dates and all times. That's continuous information about both the inventory as well as cost of sales. Periodic system determines the inventory and takes cost of goods as the residual figure, whereas the perpetual inventory system directly determines the cost of goods sold and it computes inventory as the residual figure or as the balancing figure. Cost of goods sold includes the loss of goods also, as goods which are not in the inventory are assumed to be sold, and therefore this is an anomaly here in a periodic inventory system. But in the perpetual inventory system, the closing inventory will include the loss of goods, as all unsold goods are now assumed to be in the inventory. So therefore, when we find out the closing inventory, we'll have a picture of the loss of goods also. Now, under this system of periodic inventory, inventory control is not possible, but perpetual inventory system allows for better control or complete control over the inventory. Periodic system is not very expensive. Perpetual is the periodic system requires the closure of business for counting, but that is not required to be done in the perpetual inventory system. So having understood the methods of counting, methods of recording the inventory, now we get to the formulae or to the methods that we require to determine the cost of the inventory. So how to work out, how to value the cost or how to value the inventory, that is we come to the techniques of valuation therefore, and there are two methods for it, as we saw earlier also. There are historical cost methods and the non-historical cost methods. So first of all, we'll see the historical cost methods, and when we say historical cost methods, we start with saying that there is no unique formula for determining of the historical cost of the inventories, because different techniques of valuation are used, and therefore there is no single formula for historical cost. So let us see which are the different techniques for valuation of the inventory. The first technique is the specific identification method. Now, under this method, because this method is based on the actual physical flow of the goods. Now, this method attributes specific costs to identified goods and requires keeping different lots purchased separately. So, to identify the lot out of which the unit in the inventories are left. So, what we do here is that the physical flow of the goods is being regulated here. We identify the goods by their lots. We divide the goods lot-wise and we keep lot-wise under various separate places in our storage. So once we make the lots of the goods, lots means groups. Every lot has a specified cost. So a specific cost will be attributed to every lot, and that cost will be mentioned nearby wherever that lot is kept in the physical place, as well as mentioned in the computer. That lot number so and so has this price. All these lots are purchased separately. and therefore each lot is separately identified. Now, the historical cost of such specific purpose inventories may be determined on the basis of their specific purchase price. So every lot has a specific purchase price and every lot has a specific production cost. So every lot of even the work in process will have a specific cost allocated to it, a specific calculated production cost allocated to it. So therefore, this is a lot-wise system, and specific identification has to be made for every lot, and for every lot specific price is to be attributed or allocated. Now, this method is generally used to ascertain the cost of inventories of items that are not ordinarily interchangeable, because it is not possible for ordinarily interchangeable items to be kept in proper lots. And this method can be utilized better, in an easy way where items are not ordinarily interchangeable. They are not uniform in nature. They are separate items. And of course, their value is high. Like, when we are buying expensive medical equipments. So every item is different and it can be kept in a separate lot and its price can be identified. Its cost can be separately identified in the lot from the lot. Otherwise, it requires the use of FIFO or weighted average price formula. Because if there are expensive medical equipments, then or high priced equipments which are not interchangeable, then we can use the specific identification method. And in other cases, we have to use the FIFO method or the weighted average price or average price formula. So specific identification method can only be used in specific circumstances also, where the cost is high and items are not interchangeable. Otherwise, we have to use the FIFO or the weighted average price formula. So let us understand the FIFO method. Under the FIFO method, there is an assumption that we make, and the assumption is that the cost should be charged to revenue in the order in which they are incurred, which means thereby that whatever cost is incurred first, that cost itself should be charged to revenue first, which means that when any item is sold, then we have to take that whatever item was brought in first, that is being sold. We assume that, we make an assumption that whatever item was brought first or bought first, that is being sold first, and whatever item was bought later is being sold later. This is an assumption being made. First in, whatever is first in goes first out. So the inventory of goods on hand therefore consists of latest consignments. So we'll always have the latest consignments with us because the older consignments have been sold off. The older goods have been sold off. Therefore, the closing inventory is valued at the price which is paid for the latest consignment. The FIFO formula assumes that the items of inventories which were purchased or produced first are the ones which are consumed or sold first. And the effect of it is that the items which are remaining in the inventory at the end of the period are those items which are most recently purchased or produced. So whatever items are in the inventory, we value them on the latest bill or the latest purchase. Now this assumption is in line with the good business practice to dispose of those goods in the order of their acquisition. Whatever goods are purchased earlier should be sold earlier. They are in the interest of the business. But as we know, sometimes the customers can always make a request that, okay, I want the latest item. I don't want the older item. So the businessman is items, older items and newer items, all types of items. But while valuing the inventory, he is making the assumption that the older items were sold earlier. Though it is always good for the business, especially in case of perishable goods and items with frequent technological changes, that the older items should be sold off first. It must be kept in mind that this assumption of cost flow or goods flow need not be true as a physical fact. What we are assuming here, that the older items are being sold earlier, it may not be a physical fact, but it is not necessary that goods which are physically also sold or issued in the chronological order of their purchase or production. The assumption relates only to the method of accounting and not to the actual physical movement of the goods. So if we take an example of the FIFO method, a manufacturer has bought certain goods of certain quantities at a certain price, and the total quantity purchased is 2,600 on various dates. Now he issues 1,600 units during December till 18th of December. So we have to find a closing inventory. So let us say we follow the FIFO method here. When we follow the FIFO method, we are saying that out of 2,600 goods which he had purchased, he has issued 1,600 already by 18th of December. Since he has issued 1,600, he is left with 2,600 minus 1,600, which is 1,000. So the closing inventory therefore is 1,000 units, and out of these 1,000 units, 800 units were purchased on December 28 and 200 units were purchased on December 29. So we'll assume that whatever goods he has issued, they were the goods which were, he is issuing the goods on a first in first out basis. So we'll calculate the 800 goods price by 800 into 47, 200 goods price by 200 into 60. We are taking that price, which is the latest price, and find out the total price at 49,600, and that is the inventory valuation in this case. On the other hand, we have the last in first out method also, and as the name says, the last in first out formula assigns to the cost of goods sold the cost of goods that have been purchased last, though the actual issues may have been made out of the earliest lot on hand. Here what is being assumed is that whatever is purchased last, that is issued first. It is the very opposite of first in first out method. So whatever goods have been sold, for those goods we take those costs that were the latest cost, that was the last cost that we have incurred. The closing inventory then is assumed to consist of earlier consignments, the older consignments, and its value is then calculated according to those earlier consignments. Under this system, the goods which are issued are valued at the price paid for the latest lot of goods rather than the earlier lot of goods on hand, which means that the inventory of the goods in hand will be valued at the price paid for the earlier lot of goods, as against in FIFO, where the inventory of goods in hand is valued at the price paid for the latest lot of goods. In the absence of the details of issue, we do not have the details as to which good was issued when and under which lot. So the price paid for the earliest consignment is used for valuing the closing inventory. We don't have the exact details out of the goods which are remaining in stock as to when they were purchased. So we'll use the last one, the earliest one, for valuing that inventory. The LIFO method is based on the principle of matching the current cost with the current revenue, as cost of recently purchased or produced goods are charged to cost against each sale. So here the basic premise is that the cost of the recently purchased or recently produced goods will be charged to cost against every sale. So the cost of goods sold under this method will represent the cost of the recent purchases. We say that when we are selling some items, we are selling the recent items, the recently purchased items. And that resulting that there is a better matching of the current cost with the current sales. In order to ensure that matching of current cost is in better match with the current sales, this method is utilized, called the LIFO method. Now let us say in the previous example, we assume that the following issues were made during the month of December. So we are just changing the issue part. Let's say on December 5, 500 units were issued. On December 20, 600 were issued. On December 29, 500 units were issued. So total issue is 1,600. So out of total 2,600 purchase, 1,600 has been issued at these dates. Now supposing we have to use the LIFO method, what we'll do is that we are writing the items which are being purchased, receipts are being written here, the quantity of the receipt, the rate of the receipt, and the amount of the receipt. Against that, we are writing the issue quantity, issue rate, and the issue amount. So let's say on December 5, certain thing is issued. So when on December 5 we are making the entry, we are writing the issue. So 500 quantity, rate 550, and 25,000 is the amount here. So when we are writing this one, we are saying that the last in is the first out. So we say that 900 was the last in, and out of the 900 we have issued the 400 out. So we keep on getting the balance in the inventory. So 900 was the quantity valued at 45,000, and this issue quantity of 500 is being valued at the same price, which is the price for the last issued. This is 50 rupees. So here also we are writing 50 rupees and getting 20,000. Then we are getting a receipt of 400 items at 55 rate. We are also getting a 300 at 55 rate. We are getting a 200 items at 60 rate. Then we are issuing on 20th of December, we are issuing 200 items. So when we are issuing these 200 items, we are taking this last rate of 60 and not the first rate of 50. In FIFO method, we would have taken the first rate, but here in the LIFO method, we are taking the last rate as 60. So 60 is being written here. After that, let us say we are issuing 300 more items. So this 200, let us say, are issued. When we are issuing 300 more items, then we are taking the rate of is 55. Actually, what we have issued is here on 20th we have issued 600. So out of the 600, first we take for this 200 the 60 rate, and this 60 200 is over. Then for the next 300 we take the rate of 55. Then for the next 100, because total 600 have been issued, for the next 100 we take the rate of 55, which is part of this 400. So 300 more are now remaining. So then we get 800 for 47. And then when we issue 500, we don't take this earlier rate here. We take this 47 rate. So all the time, as you can see, the current costs are being matched with the current expenses. Therefore, the cost of so finally, when we issue this, the issue price is also mentioned here. We are going on reducing, and thereby finally we say that our cost of the closing inventory of 1,000 pieces will be 50,600. Because here what we are doing is that we are taking the balance inventory, and when we reduce it, we are taking the amount also. So 900 at rate 50 have been received. Out of this 400 have been issued. And these are the receipts.
Wherever we are writing receipts, they are receipts, and finally what we do is that out of all the receipts we minus all the issued items and we get the closing inventory, which in this case will be 550,600. Now here we have to understand one thing very clearly, that this method is based on an irrational assumption that inventories which are entering last in the stores will be issued or consumed first. It's not likely. Most likely every businessman will likely sell the earlier one first. However, the flow of goods which is generally observed in the business entity is contradictory to this assumption, because flow of goods is out of the earlier stock and not from the latest stock. It should be noted that while applying LIFO, there will be a difference in the cost of goods sold and the valuation of the closing inventory if the entity follows the periodic as against the perpetual method of inventory valuation. If this entity follows the periodic system and not the perpetual system, then in these two systems, the cost of goods and the valuation of closing inventory will change. Therefore, LIFO method is no longer adopted for value inventories because it is based on an irrational assumption and it leads to changes in the value if we follow the perpetual system or we follow the periodic system of inventory valuation. Also, accounting standards do not permit us the usage of the LIFO method, and generally in practice FIFO and weighted average price method have become popular among the business entities, and both these methods are also permitted by the accounting standard also. Now let us see the computation under the periodic inventory system. In the above example, if the entity followed the periodic inventory valuation, the closing inventory of 1000 pieces will be valued like this, that 800 pieces for 47 gives us this much and 200 pieces for 60 will give us this much, and total 1000 pieces will be 49,600. As you can see, the inventory valuation in the LIFO method, this is for the, you can say this is the FIFO method, and if we take the LIFO method, we can see that the cost of closing inventory has changed when we have followed the LIFO method based on the perpetual inventory method and the periodic inventory method. Because here what we have done is that when we followed the perpetual inventory system, we are just writing out the inventory here, and this LIFO method is being written on the perpetual inventory system here. The perpetual inventory system is giving us a figure of 50,600, although the periodic inventory system is giving us a figure of 49,600 for the inventory. Therefore, under the LIFO system, the periodic and the perpetual system will give different figures, and that is also the reason that why this system is being rejected and not being recommended by the accounting standards. So now, after getting to understand these systems, we go to the simple average price method under the inventory valuation techniques. We have already understood some other techniques earlier, so let us understand the simple average price method also. Simple average price for computing the value of inventory is a very simple approach. Yes.
Sir, one request, if you can it be shifted to the evening session as it's already 10:40?
Okay, fine. So let us do that, and let us continue from simple average price method. I agree with your request because time is also very important. So we'll start with simple average price method in the evening at
Thank you,
9.
sir.
So we close the session right now here, and we begin with continue the session as part 2. in the evening at 9 p.m. Please join us at 8:45 p.m. in the evening. Thank you so much for having joined us for this session.